Welcome to Holy Kool-Aid Live. I am here today with a very special guest. He is a financial advisor. He is the host of the cleverly titled Phil Ferguson Show. He also has been very active in the skeptic and atheist community for quite some time. I keep running into him at conferences. He is a public speaker. He has been on the board of a number of organizations, including I believe, is it the Secular Student Alliance, Phil?
Secular Student Alliance, Atheist Alliance International, and I was the treasurer for the Reason Rally in 2016.
Fantastic. So he has been all over the place. He also is the president of an organization called Polaris Financial Planning, or Polaris Financial, is it Planning?
Planning, yeah. Yep.
Man, I really have butchered this intro. I normally have it written down, but I've been having some technical difficulties getting my camera set up in this new studio. So I wound up just resorting to my old webcam for this stream, and hopefully I'll have the full beautiful HD experience set up in the next one. But Phil Ferguson, thank you so much for joining me on the show, and welcome to Holy Kool-Aid.
Well, thank you very much. It's my honor to be here. And of course, your listeners may know that you were on my show recently. And of course, I was honored to have you as well. I've ran into so many different conferences. I was like, it's about time I get Phil on, because the topic today is a very fascinating conversation. It is applying skepticism to the world of financial investing. And you might be asking yourself, like, finance and skepticism and atheism, like, how is any of this related? Where is the joint connection there? And many of you have seen me make videos about psychics and how they con people out of their life savings and how they prey on the bereaved, and how we need to apply skepticism to not be duped by people like this, to not be duped by cult leaders or by charismatic authoritarian regimes and cult followings, cult leaders, religious faith healers, you name it. And the world of finance is not immune to that kind of charlatan. There are people who will bilk you out of your life savings and who will offer you these plans that seem too good to be true. So I decided to have a expert in this field to come on and talk about it. Well, let me know when he comes on. I'd love to hear it.
So Philip,
I do have a quick question. Am I allowed to swear, or are you trying to keep these PG?
You are allowed to swear. Normally in my shorter videos, I keep them fairly family friendly, but when I have guests on, I do not censor.
All right. Fair enough. I might slip up. It makes it easier if I don't have to think about it too hard. What was your question? I'm so sorry.
So I have a number of questions. Usually the way that I do the format of this show is I will have a guest on for about 30 minutes and I will interview them. And then at the end of the 30-minute period, I post a link to my Patreon, a private, exclusive patrons only link. If you are a supporter of the show, and you can become a supporter at patreon.com/holykoolaid at any dollar amount, you can pledge $1 and you get to join us live on air to ask your questions, to hang out with us, and to just spend some time. It's kind of one of the perks I like to give back.
Your fans can do after they go to Patreon/holykoolaid and donate money to you. Only after they do that, they can go to Patreon/Phil. And that's where they can support. I just, it just went live today, actually.
Really?
I've had people asking me for several years, and I just finally, I guess, got around to it. So
I was wondering, a few days ago, I was kind of looking around seeing what links you have, and I found your show, your Twitter and everything, but your Patreon didn't really seem to. I guess it's brand new. So let's go and support his show as well and see if we can get that up a little bit.
Yeah, I did already have a fan of the show ask what I'm going to do with the money, and I don't know yet. Because one of the things is that my show, my podcast, the Phil Ferguson Show, is really meant to teach people how to money, and through that, I promote myself like anyone who does a podcast or a video, and I promote my business, and I've over the years gotten quite a few clients from that. So I'm able to pay my bills. I didn't need the extra money, but I had a lot of people who said, I feel obligated to kick in some money because you've been so helpful. And so I've finally got that set up. But I'm not sure. Maybe I'll do a mix of some charity work and maybe a pair of tickets to Italy if enough people donate. I don't know. We'll see.
Awesome. So I have some questions here lined up. I first wanted to talk with you about the trend in investing. You know, we had quite a few years of boom, and then we had the 2008 financial collapse, and it seems like the stock market has been doing all right in the last few years. But have you seen, as inflation has gone up, as more and more people are working multiple jobs just to make ends meet, have you seen a decline in the amount of investment among millennials than, say, past generations?
Wow, I don't really have that kind of data at my fingertips. I do know there are an awful lot of millennials that are struggling. Uh, I also know that when I was in my 20s, I struggled really hard. I got out of graduate school in '92 with an MBA and could not get an NBA type job at all. There was because that was a little recession 90 91 time frame. There were no jobs to be had, and I ended up working part time and then full time in a record store. Remember records, and ended up working for them and getting promoted to full time, and then the third key holder, and then the assistant manager, and then a manager of a record store in a mall, and went from there. And eventually got into some corporate jobs. But if you come out at a recession, it's really rough. But I do know quite a few former students because of my involvement with the Secular Student Alliance. Some of them have done amazingly well, and some are struggling. They've moved to a big city and they're sharing apartments with 4 or 5 other people, and they're just trying to get by. I don't have any way of knowing if it's particularly better or worse, but it does kind of seem kind of sucky for a lot of people.
Yeah. Well,
And I think probably not that there's not enough jobs available because unemployment is low, but a lot of companies are being really tight on wages. So people that are working aren't getting that much money. And recently we had, within the last year, this giant tax cut, which I did not support. And it was thrown around that when you give these giant tax cuts to rich people and to corporations, that the money will trickle upon the lower people, and it doesn't work. It never works.
trickle down economics.
Yeah, trickle down. I say trickle upon, whatever. It doesn't work. It didn't work. Companies used a lot of the money to pay executives. They used a lot of money to buy shares of their stock back, which was a positive force on the stock market going up. How much it played in the market going up in the last year, it's hard to calculate something like that, but it was a positive factor. But in the long run, a negative factor is if people can't buy shit, companies are going to have a hard time selling stuff. So that becomes a problem.
Yeah, for sure. Now, I have seen that there has been this trend now in using, before that the stock market did have kind of a high barrier of entry in order to get involved, with high, trading fees. And, you usually wanted to have quite a bit of money starting off. But now there's been this trend of these new investment platforms like Acorns and Robinhood and stuff that let you get on at a much lower level. And I'm a little skeptical with that because one thing that I've noticed is that sometimes you'll have people get in where it'll say like, oh yeah, just you need pennies to invest. You just start off and it'll round up your transaction fees and send it off, to invest in the stock market, 50 cents here, a dollar there. But if you're starting off with $10 in stocks and you're paying $1 a month to use these platforms, that's already a 10% loss at the end of the month. Would you recommend using some of these smaller alternatives for if you have, say, less than $1,000 worth of money to invest?
Sure. It's something that I've actually probably the single most requested thing for me to do is look at apps like this. And there's a number of them, and they're growing in number, and they are very popular, and they seem to be very popular with 20 somethings and 30 somethings. And after looking at them, and I did a podcast completely on Acorns, and I did a podcast where I covered not quite as much detail as I did on Acorns, but I did Robinhood. I've also looked at Betterment and a couple of others. And the really short answer for me is no, don't fucking do it. Don't do it. And the funny thing is, to get into a conventional, old school, boring investment portfolio, before you needed only $1,000 to get what's called a target date fund at Vanguard, where they would buy the entire United States stock market, the entire international stock market, and a whole bunch of bonds, and you can have this incredible diversity for as little as $1,000. Now, in order to keep up with the competition, Fidelity has launched some funds that have zero minimums. Vanguard hasn't yet met that, but if you have $0, you can open up an account anywhere. But to start investing at Fidelity, you need, I guess, $1. So you can go online to Fidelity. You can select, put in $5 or $10 in the Fidelity Spartan Total Stock Market Index Fund and own an incredibly small fraction of a share of virtually every stock in the entire United States of America. You can set it up to your bank. You can put in $5 a month. You can put in $10 a month, and it works. Fidelity doesn't have the really cool app on your phone like maybe Betterment or Robinhood or Acorns does, but it works. So you have to ask yourself, are you investing to get really good performance and really good returns, or do you just want a cool, sexy app? I don't care about the app. I want to make the returns. The long breakdown I did on Acorns had a lot of problems, seriously hardcore problems, where when you invest at Acorns, the money is not held in your name. So if Acorns goes broke, your money could disappear. That's a big freaking problem. And there was a whole bunch of other problems with Acorns in particular. And I don't want to spend too much time on that here, but you could go listen to that podcast, the Phil Ferguson Show. Maybe I can find out the show number and send you a link to it. But don't use Acorns. If you want to use Robinhood and trade in a few stocks, you can do it. It doesn't seem horrible, but it goes contrary to my investment advice. You're much better off with that Fidelity or Vanguard index funds. And at Fidelity, it's $0. At Vanguard, it's $3,000 to get the total stock market index. It's $1,000 to get the target date fund. And what I tell people on a regular basis, the problem is not trying to figure out how to efficiently invest $100 or $200. The serious hardcore problem is that you have $100 or $200. That's what you got to fix. You're spending a whole lot of effort trying to figure out the best way to invest $200, and it's cool. I appreciate that. But what you need to do is figure out how in the fuck are you going to get a lot more money than $200? Because if you're rounding up to the next dollar or up to the next $5, or you're saving $10 a month, you're never going to retire in that. It's just not, it doesn't matter how good the investments are. It doesn't matter how efficient they are. It's just not going to work.
Even with the power of compound interest.
Well, and one of the things that I must have said it offhandedly one time, people talk about saving 10% of your money. I call saving 10% per year the suck-ass minimum. It won't work. It will not work. Okay, if you start when you're 22 and you want to retire at 65 or 67, it might actually work, 10%. Most people don't start saving it at 22. You have bills to pay, and then you get involved with somebody and you live a little bit, and then you have kids, and then you buy a house. And then all of a sudden you're 35 and you go, oh shit, I got to start saving money. 10% is not going to work unless you want to work into your 70s. And most people don't. Or you could choose to retire on far less money than you make working. I don't find that a sexy concept. If I've worked and struggled and got up to a nice high paying job, when I then go to retirement, I don't want a 30 or 40% pay cut. I don't want to live in a single wide trailer under the power lines because that's all I can afford. I don't want to make those choices. So 10% is nice, but it's not going to be good enough for most people. You need to do 20%. And when I tell people that, they're like, well, there's no way I'm going to save 20%. Well, I mean, if you don't cut corners now, you're going to have to cut corners then. And then you can make an educated choice. But often we find there's a lot of things in our life that we think we need, but we don't really need. We want. And we have to resist the want and stick to what we need. And like I had a young guy that was 28 and he'd saved up $50,000 working. And we were talking about what to do with the money, how to invest it. And he calls me back a couple weeks later and he says, never mind. I bought a truck. What do you mean you bought a truck? He's like, yeah, I got a Dodge Ram 3500 long bed, extended cab, dually, super cab, whatever, hauling package and everything. And I'm like, that would be almost like 50 grand. He goes, yeah, I spent almost $50,000 on it. So I don't have any money to invest. And I was like, but that could have been like almost your whole retirement by the time you're 60. And he goes, yeah, but I've been working all these years, because he's 28.
Yeah.
I've been working all these years and I deserve a new truck. I go, you fucker, you don't deserve shit. None of you deserve shit. I don't deserve anything. You work for things, you save money, and you buy things. And it's all about choices. You don't deserve anything. Maybe you deserve health insurance. We can go down that rabbit hole. Maybe you deserve to have a roof over your head and basic income for people who can't manage to work on their own. But you don't deserve a $50,000 truck. That's just crazy. That's a priority problem.
Well, I want to pull you back a little bit to the world of skepticism here with, when I look at people who are investing their life savings, it seems like, there are a number of people who will come along and offer you something that seems too good to be true. Invest in these penny stocks and you're going to get a 50%, like some, amazing, option. How do you spot a con artist? And how do you find a trustworthy financial investor?
Financial advisor, I'm assuming you meant.
Financial advisor, sorry.
Yeah. Well, one of the very first things is you need to understand how markets work. So if you would like, I can give your listeners or viewers a list of books they could read. Would that be helpful?
Yeah.
The first one is a very quick and easy book. It's got stories, no math. It's very simple. It's called The Richest Man in Babylon. It's 100 years old, so it's out of copyright. It's usually $3 or $4. It's even free on YouTube. Someone read.
Yeah, I listened to it on YouTube. They have an audiobook up.
So it's a great starter book, and it's just about why do you save money? What's the value of saving money, and how does that work? After you finish that, and I do recommend these in order, even for advanced investors, people who've been doing it for a while, because especially The Richest Man in Babylon, if you're a quick reader, it's 2.5 hours. Just read it. You'll enjoy it. The next one is called A Random Walk Down Wall Street. And this is a classic book, came out in the 70s, and it's revised every 5 to 7 years. And it teaches you a lot of the vocabulary. This is a stock, this is a bond, this is a mutual fund. And you get a basic fundamental understanding of what everything is and kind of how it works. The next one is called Winning the Loser's Game. And I just added this one to my list because I had 3 and now I have 4. But Winning the Loser's Game also first came out in the 70s and is revised every 5 to 10 years. And it talks about how markets work, how index funds work, and a lot of more detailed stuff. And then the 4th book is Common Sense on Mutual Funds. And the first 3 books, I don't care how you get them. You can get the audiobook, you can get the Kindle, you can get paperback. But Common Sense on Mutual Funds, if you want that 4th book, it has a ton of data. It has charts, graphs, statistical analysis, deviation information. It is filled with wonderful, glorious data that I love, but not everybody does. But you can't do that in an audiobook. And it doesn't format right in Kindle because I bought a copy of it myself. So that when you have to get in hardback and treat it like a textbook, and even if it takes you a year to get through it, you might be investing for 30 to 50 years. It's an investment in your future. But when you look for an advisor, there's a couple things that I recommend. One is you want to have an advisor that is fee only, and you don't want fee based. You want fee only. And
what's the difference between?
Yeah. Fee based means that they charge you a fee, but they're still free to collect money from any other source that they want to. But it sounds like fee only. So they're trying to, it's like some cars will say hybrid because they put in one little cool thing that increases your mileage by 1 mile per gallon, but it's not really a hybrid car. So you're not really getting what you thought you were with the label. Fee only means that they should, and they should be willing to put this in writing. The only source of income that they have is from paying clients. The next thing is that advisor, you want them to be a fiduciary, and a fiduciary, just like an attorney or amazingly like a priest, when you tell them something, they can't turn you in for it. They have to work in your best interest.
So kind of like a client confidentiality agreement.
Well, like if you went to an attorney and you happen to tell them that some of the things that you did in the last year were illegal. And they said, well, a couple of these things I'm going to keep secret, but one of those things I'm not going to keep secret. I'm going to call the cops and turn you in. They're definitely not working in your best interest. They just ratted you out. So attorneys have that fiduciary responsibility where they have to work in what's best for you. Now, they can still charge you a lot of money, and that should be clear and disclosed, and it should be fee only, and you should know exactly what you're paying and why. But once you've got past the money, they work only for you and they don't collect money from any other source. And so that removes a whole lot of the conflict of interest, because you could end up meeting with a broker or an insurance agent that says, hey, do you have cancer insurance? And you go, what? I didn't even know there was a thing called cancer insurance. And if you get cancer, it could provide you up to $50,000 of insurance to help pay the medical bills. And it's only $10 a month. And you think, well, that's great. Only $10 a month. I should get that. Well, in the fine print, you have to have an extremely rare form of cancer to get the $50,000. If you just get breast cancer or rectal cancer, colon cancer, lung cancer, you get a couple $100. And so you're paying $100 a year for 10 years. You pay $1,000 or $2,000, and you eventually, unfortunately, you get cancer, and your payout is $200. You're like, but wait a minute, I paid $2,000 into this thing, and the only thing I get out. And then, of course, if you don't get cancer, which is awesome, you don't get any money back at all. And the person selling it might make a $1,000 or $2,000 commission because they sold the product. That's what the commission is. It's like selling new cars or used cars. There's a commission to be paid, and you want to know what that amount is.
So an advisor who's not fee only has these incentives to sell you on bullshit that you don't need.
Right. And one of the worst things is that if you buy an annuity, I'm not aware of any kind of legal limit how much they can make, but usually it's 10, 15% is the really, really high ones. And an annuity that pays a higher commission is likely annuity that is less good, bad, evil for the investor. But if you suddenly inherit $100,000 and you meet someone that sells you an annuity, they can make $15,000 when you invest in. I can do this because it's video. Invest. You invest your $100,000, they might make a $15,000 commission. And the other thing is that since they get paid once via commission, once you've signed on the dotted line and bought the product, they don't really care. You are a distraction. You are consuming their time and preventing them from selling somebody else. Whereas a fee-only advisor, someone who works like myself, I get money every year from a client. I want to keep them happy. I want them to stay. And since I went ahead and mentioned that, I'll just say it's about 1% per year on the assets under management, and it goes down with higher tiers of money. But so I get paid quite a bit of money. And the idea, the goal, the fantasy, the dream is that the people that hire me make more on their money than they would on their own. But they're not compelled to stay. There's no contractual obligation for them to stay. At any time, they can say, Phil, it's not working like I thought it was going to. I don't want to pay you anymore. And they're out.
So that's what you mean when you say that people work for who they get paid by. You say that a number of times on your show. You're talking about if they are fee only and they're only getting money from you, then their responsibility is to you. They want you to succeed because they're making a cut off of your success rather than just trying to sell you on bullshit that you don't need.
Right, exactly. And I don't necessarily want to throw out names, but let's say Northwest Mutual. If you go see an insurance agent, they're not even an financial advisor. And by the way, financial advisor is not a legally recognized term. So anyone can call themselves a financial advisor. Or an investment advisor or a wealth manager. There's no regulation on any of those use of terms. So you go see someone who's a financial advisor, they're actually a insurance sales agent, and they take your $100,000 and they put it in an annuity and they make 15 grand. That's not in your best interest. It's in their best interest. They just made $15,000 for spending a couple hours talking to you and convincing you that something was really good that probably isn't really good, because it has to pay him $15,000 off the top.
When you say that you said that before that there are now options where you can get into investing in stocks for even if you have $0 or $1, you can start investing. And that they diversify your portfolio. Now, I've heard some higher level investors say that diversifying your portfolio is nonsense and it's only for people who don't know what they're investing in. Do you agree with that? Or obviously, the stock market as a whole tends to grow. What is the value, the pros and cons to diversifying versus investing in just one
Yeah,
stock?
and it's a weird thing in the investing world. There's two divisions. There's the people that sell things, recommend things, they make money off the markets, and then there's the people in the ivory towers that work at universities and they do research and they study data over long periods of time and they don't ever talk to clients. And the two camps don't really get along very well. They don't talk very well. Um, and in part because the idea of telling you to put your money in an index fund, which are very competitive for price and make very little money for the brokerage firm or the qualified custodian that you put your assets in, that doesn't make a whole lot of money. It's not even maybe in their best interest, but it's in your best interest. So I think someone that says that by you picking a handful of stocks, you're going to do better is ignoring the reality of the data. They just simply either haven't looked at it, they're willfully ignorant, or they're fucking liars, because most people are not going to beat the market. They're not even going to get close to the market. And the expense of trading, getting in and out, the tax consequences of getting in and out consumes a big chunk of your return. Now, can there be a person that 20 years ago bought $10,000 of Apple and they're now a millionaire? Of course. There's always those people, or bought Microsoft or sold Facebook before it went down 30% this year because of all the problems that they've had. It can be done. Some people beat the market. But one of the things in Winning the Loser's Game, that book in particular, when you get to that in the series, it talks about the idea that, so if you wanted to get a really good advisor and you pay this person to help you pick stocks, and you say, well, that's not good enough. I want a second advisor. And I want every single person that manages every single mutual fund to help give me advice. You know what that's called? That's called the stock market. Because their collective wisdom goes into setting the price of each and every stock and the price of the stock market and indexes in the stock market. So all of their advice comes together in a sum, and you have access to that for free.
Yeah.
Now, when you, as Joe Schmo or Mary Schmo, start buying and choosing individual stocks, you are declaring that you are better than the sum total knowledge of everybody else in the market. And that's likely not going to be true.
Well, they'll point to people like Warren Buffett and they'll say, "Well, he invested in Coke, so I'm going to go buy Coke shares." It's like, well, wait a second. Warren Buffett isn't buying the same kind of shares as you are. In fact, he's going out and he's actually purchasing companies and he's, revitalizing them, fixing them, and improving their value.
That was brilliantly said. I couldn't have done it better. That because people often point to Warren Buffett, but Warren Buffett is not a stock picker. He was originally in the 60s, maybe even in the early 70s. But for several decades, he's not been a stock picker. He's not picking winning stocks and then selling them at the right time. He's taking over ownership of companies and fixing them and dramatically increasing their value. Thomas, unless there's something I haven't heard about you yet, you're not going to be doing that. I am
not anytime soon.
The vast majority of all Americans are not going to swoop in, buy the majority share of a big company and fix it. We don't have that kind of asset. We don't have that kind of wealth. We don't even have that kind of knowledge because we're so busy in our day-to-day operation. So when people say you're better off picking stocks, the data says they're wrong.
Well, and even when he invested in the early days, one of the books he recommends is Benjamin Graham's The Intelligent Investor, and his investing style is for the long term. He's not flipping stocks. He's not just, in while it's low, out while it's high.
And the other thing is that he started in the 60s and in the 70s, and this goes to the fact that way back when, You being an individual stock picker, you could go find a company. You could outsmart the market because the market wasn't sophisticated. The market wasn't advanced. There weren't as many mutual funds and managers and people shopping and looking for the best deals. You could go find deals by doing diligence, just
And
like
there
Warren Buffett.
weren't entire rooms full of the smartest people from MIT writing computer programs to.
And that's the beauty of winning the loser's game, because the idea is that in a loser's game, you are not gonna beat the other people because
Mm,
you don't have the technology, you don't have the connections, you don't have the money, you don't have the speed. You can't beat them. It's just not gonna happen.
mm,
So once you embrace that, the best that you can do is to match them. And the funny thing is, most people don't match the market because a lot of people are trading. And so if the stock market in the long run makes about 10% a year, most mutual funds make 7.5 to 8% per year. Mutual funds, managed mutual funds that all think they have really smart people, and they do. And they've got CPAs and MBAs and really educated people doing lots of research and trying to figure out which companies to buy. And the reason they underperform the market is because collectively they can't beat the market because they are the market.
mm.
But then they have trading costs and overhead, and they want to get paid for the shit that they do for you. And so the net effect is they match the market collectively as a group, but when you include their expenses, they make about 8, 7.5 even. Now, you take the average individual investor, they don't make 7.5 or 8 when the market goes up 10. They make 6 when the market goes up 10 because they're not always buying the best deals. They're not always getting in at the right time. Their trades aren't executed first or fastest. It's a really hard thing for you as an individual person to beat the system. So you just embrace the system. You buy index funds. When the market goes up 10, you make 10.
Mm.
Okay. And you did no work. Your taxes are incredibly small because there's very little turnover. And like you talked about before, the trading costs are next to nothing. It's magic. It really is.
Hmm. Yeah, I'm looking at the chat. It looks like
Uh-oh.
Chief Nerd says index or my security blanket. I'm real curious. Everyone in the chat right now, why don't you first give us a shout out? Let us know where you are watching from, what country, what state. Oftentimes we have people from all over who are fascinated and who are tuned in. Also, I want to give a quick shout out to Travis Bell, who pledged a super chat of 666. So thank you so much for that, Travis. If anyone makes a super chat, I read all of them live on air. So if you have questions for myself or Phil, feel free to post those in the chat, any dollar amount. It really helps support this show. If you haven't noticed, I've been upgrading my studio. So I just got a new microphone that is amazing, actually, thanks
I have the
to
same microphone.
Chief Nerd in the chat for sponsoring this. And we've also set up all this foam to make the room sound better. And
I like your boom arm though. That I'm gonna have to find out later what model that is because mine sucks.
oh, I love this thing. It's beautiful. And so there's a few other tweaks, I'm kind of working on to increase the quality of the show, a few things here and there. But for the most part, we have made drastic improvements to Holy Kool-Aid, and it's only getting better from here. So thank you to everyone for your continued support. Thank you for all my patrons who have made this possible. I'm actually about to open the show up to bring you guys in. I'm going to be posting the link here. It looks like while I do that, let's read some of this off. We got someone from Asheville, North Carolina, Denver, Colorado, Canada, London, UK, Edinburgh, Germany, Seattle, US, West Coast, US, Perth, Western Australia, Denmark, Wisconsin, Belarus. Wow, we got people from all over. So thank you guys so much for joining us. I've got a few more questions for Phil. And while I do that, I'm going to post the link for you guys to join through Patreon and to join us live on air. Just make sure that you have a working microphone. If you have YouTube open, mute it because you're going to be talking to us through Google Hangouts and we don't want to get some feedback. Have some headphones plugged in so that we're not getting feedback through your mic. And I'm posting that right now. Also, let me know. I'm going to be watching Patreon. Last time we had an issue where the link was broken and people were having a hard time joining it. And so we wound up doing a exclusive patrons only show separate where we did, kind of a follow-up show to get that for you guys to be able to join us on air for all the patrons. But hopefully this link works this time. I'm clicking on it just to make sure on my end. Oh yeah, it looks like it's working.
You mentioned the 666. I don't know if you noticed on my Patreon page, the top tier for donors is $6.66 per episode.
Fantastic. I love it.
Yeah. So
it's the patron of the beast.
Yes, that's right.
Got someone from Oregon. Also, let us know in the chat, what type of investments have you worked with? Have you worked with CDs or with index funds or bonds, or what type of investment is your investment of choice? Let us know, and maybe a quick why. And it looks like we are joined right now by patron Matthew. Matthew, welcome to the chat.
Hi.
Do you have where are you connecting from?
I'm from Edinburgh. I'm currently a physics undergraduate here.
Oh, fantastic! I love physics. So, do you have any questions for Phil that you'd like to ask?
Honestly, I don't know, because like I'm really just starting to learn about investing. I'm just wondering what I could learn here.
Okay, awesome. Well, or more. I forget what the limit is with Google Hangouts, but as it fills up, sometimes we cycle people out, whoever's been in the longest. But right now we only have a couple, so feel free to stay in. If you have questions at any point, feel free to chime in and ask your questions. It looks like we're also joined by Erstwhile. Erstwhile, welcome to the show. I think last time Erstwhile joined us in the patrons only, and he was having some mic problems, so that might be an issue now. It looks like he's muted.
Yeah,
so.
But as far as Matthew's question, reading the books that I talked about is great, and a lot of the stuff I talk about does translate from one country to another, but a lot of it doesn't. I'm sure there's different rules in England. You can set up a brokerage account of some kind, and you can probably buy a British-based ETF or an index fund, or maybe you can get British versions of American or Vanguard or Fidelity funds that are sold in the United States. But yeah, outside of that, I don't know. I think if I was, usually when I talk to someone in another country, and I have to first admit that I don't know what the fuck I'm talking about when it comes to another country. So people are very excited about investing in the United States, but I always like to think that it's good to have some of your money, a good chunk, anywhere from 25 to 50% in your home country, because that economy or that currency is going to make a big deal in how you do in the long run. In the case of England, Great Britain, United Kingdom, whatever words we're going to use right now, I'm going to say 20 to 25% is all I'd have, because the Brexit thing may be a big explosion and not be cool. So I would want to try to have money other places. And wherever you're investing from, and this even applies in the United States, if you invest in stock from other countries, you have to have a very good understanding, are those investments balanced back to your home currency? And so in the United States, if you buy an international stock fund, and I happen to know at Vanguard, if you get international stock funds at Vanguard, that every single day they adjust the investments to compensate for fluctuations between the dollar and a basket of world currencies. Because if the dollar happens to go up 20% in value and all your international investments made 5, you end up losing 15 because the dollar got stronger and all your money is overseas. So you did okay in the international investments, but because the dollar got stronger, you got screwed. So now you're doing a currency hedge, not international investing. So you have to make sure that whatever you're doing to invest is doing that currency adjustment.
I see. Thank you very much.
You bet. Glad to help.
Yeah, I have someone here asking about Money Farm, but real quick on that same topic, Chief Nerd saying Great Britain is a very dangerous investment at the moment, and the EU is scary. I have investments in both. It has been a roller coaster over the past 10 years, but sometimes it is great. And then Steve Phillips is asking, what about sites like Money Farm? Or what is Money Farm? Do you know?
Well, I don't know Money Farm, so I can't address it specifically, but I've kind of taken the position because there are so many new and interesting ways to invest that I'm waiting for one of these sites to show me empirically that they're better than the traditional way of investing. So I can go set up an account at Fidelity with no money. I can get in the total stock market index with no money. I can connect it to my bank and start adding $5 or $10 or $20. If somebody else is going to do something, they have to show me that they can do better than that. And no one's done that so far.
Real quick, we have someone else joining us. It looks like Cody. Cody, welcome to the chat. And Tyler, both of you guys.
Thank you very much.
This is a fun new experience for me. I welcome everybody.
I'll start with Cody because I think you joined right before Tyler. Cody, do you have any questions for Phil?
Yeah, kind of. So I've heard of Forex trading, foreign exchange, currency trading. Is that what that is? What is that all about?
My understanding of Forex is it's a really good way to get fucked hard. So there are classes that you can pay hundreds and thousands of dollars to go in and do Forex trading. I don't do trading. I do investing. So it's not really in my wheelhouse, but I had someone just 6 months ago called me and said, I went to this seminar and for like $500, I can get all this training and I have to buy a better computer and I have to get this high-speed data bandwidth connection to the internet and I can start doing Forex trading. And I'm like, what the fuck do you know about international money fund trading? I mean, it's kind of like, if someone calls me and says, Phil, what do you think about me investing in straddles or puts and calls or Bitcoin or this new app or Forex? My response generically to all of those kinds of questions is that if you're asking me, no, because you had to fucking ask me. That means you don't know shit about it, and it's a good way to get wiped out. So sorry, there's my short answer. Don't do it.
Do your research.
Gotcha.
Yeah.
Real quick, I forget if I shouted this one out, but Chief Nerd, thank you so much for the $10 super chat. And we also got one from 0132132. He says, I spend all my money on super chats. If I start saving for retirement at 40, how hard is it versus saving at 30? Do I need a time machine? And first of all, thank you for the super chat. And, it's okay to spend all your money on super chats, although I'm a little bit biased in that regard, but it pays my bills. So thank you.
40 is not really bad place to start. And if you start, so what I normally tell people, if you save 10% per year and you have really good investments and really low costs and you don't do anything stupid, one of the single best things is to not do stupid shit. Saving 10% will take you 40 years. Saving 20%, you can probably do it under 30, maybe even 25 to 28 years. So if you're starting at 40 and you get serious and you start saving 20% now and every year going forward, 65 is totally doable. Retiring before 65 in the United States gets really difficult because you don't have healthcare or you have to buy healthcare. Or maybe if you were in the military, and thank you, if you were in the military, you might have TRICARE if you were in long enough. There's other ways. Maybe some companies have health insurance after you work there for 20 years or something. But for most people, even if they have a lot of money and they could retire at 55 or 60 or 62, they then have to pony up an extra $15,000, $20,000, $30,000 a year for healthcare. And
no, he wrote, not doing anything stupid isn't an option for me. I'm pretty bad at stuff. And I mean, that's why this show is here, though, is to help you.
Total stock market index until you learn more. And so you start with something that has been proven empirically to work in the long run.
You're talking index funds.
I am talking index funds. So I have about 300 clients that pay me, and I have my money, almost all of it. Because every once in a while, someone has a company stock that they can't get rid of, or they really want to buy a couple of stocks. But 95, 98% of all the money I manage is in index funds. So I sure hope I'm right, because we're putting a whole lot of money on the table here that's all in index funds. And that's what the research says. The books that I recommend, the periodicals that I read, the data that you can study, it says that the average person is going to do way better if they're in index funds.
Awesome. Real quick, I mentioned before, I asked where everyone is investing, and I've got jumbo CDs, just some stocks, Recently started off with a term deposit. Someone said Zulu trade, and then somebody else said they invest in drugs. So there's always that. Real quick, I will get to your question, Matthew, but let me ask Tyler, since I haven't gotten to him yet. Tyler, was there anything that you wanted to ask Phil?
Yeah.
If you could get a little closer to your microphone, it's a little bit quiet.
All right. Yeah, I just graduated from college, and I'm
Congrats.
wondering how much money should I allocate to investing versus student loans?
Yep. So that's a good one. That's a good one. So for me, it kind of depends on the interest rate. So if you have all of your student loans together in one place and the interest rate is 1%, I wouldn't pay a penny extra. I would pay the absolute, I don't care if it takes you 40 years to pay it off. If someone's going to lend you money at 1%, you pay that bitch out as long as humanly possible. If it's 2% or 3% or 4%, that advice still stands. 5 and 6%, it gets to be a toss up. If you have student loans that are 7, 8, 9%, now they start to get a lot more sexy to pay off, because if you have an 8% student loan, if every dollar you pay on that is like getting a guaranteed risk-free rate of return of 8%. And so you got to take that. Now, if you have student loans are 12 or 14 or 16%, I wouldn't bother saving a fucking dime for retirement. So it's all about the interest rate. So 7 or 8% or above, I'd get hardcore. And a lot of students have a handful of different student loans. So you want to attack the ones with the highest rates. So if you've got a 12% or a 10%, that's all you're going to do. Don't save for retirement. Don't do it. Just pay off the 12%, the 10%, the 8%. When you get to 6 or 7, maybe at minimum, you want to save 10% for retirement and then do what you can for the student loans. If you're going to get 5% or below on the student loan rates, especially if they're fixed, let them rot. Let them get as little as humanly possible, and you want to bank the money in retirement, where theoretically, anyway, in the long run, you're going to make 10% and pay off the 3 and 4% as long as possible.
Fantastic. Let me get to Matthew. I think you had a question.
Yes. So although I've mentioned that I'm from Edinburgh, like I'm likely to move around places like quite often. Next year, I'm getting exchange opportunity to California, in fact. And like you mentioned that I have to be careful, like to balance back to my home currency. But if I don't actually have a so-called home currency, which currency do you think is the
well,
I should base on?
It kind of depends, because if you constantly move to different countries, there's no good answer. So that's the problem. The other thing is that once you start getting large amounts of money, moving it from one country to another can be very challenging, and it can get all kinds of attention that you don't want to get. So that's one thing. There's nothing to prevent you from having a brokerage account in England and then a brokerage account in the United States. But that's problematic. Now, if at some point you expect to retire back in the United Kingdom, leave the money there and you're going to be okay. But if you're going to go from the United States to Japan, to Indonesia, to Australia, to South Africa, to other countries around the world, I don't have a good answer other than maybe if you can get a broadly diversified international fund from somewhere, because, you know, if you tie it to one currency and you're not in that country, if that currency gets really strong and you're not in that country, you're going to get screwed by living somewhere else. So that's a currency fluctuation problem. So maybe it depends. You know, if you know where you're going to retire, that'd be helpful. Then maybe you want to think about where might be the best place to invest in the long run. And assuming at some point we throw Trump's ass out of the United States government, hopefully the U.S. is a pretty good, predictable long-term investment. I think Europe as a whole is nice, assuming they figure out how to manage the euro properly. Maybe Germany would be my second bet. But yeah, it's tough to know exactly what's the right thing to do in that situation.
I see. Thank you very much.
So, to anyone just now tuning in, my guest today is Phil Ferguson. He is the host of the Phil Ferguson Show. where he talks about money and skepticism. So he applies the world of skepticism to money and people who are being bilked out of their money by charlatans and get rich quick schemes and all of that fun nonsense. Phil, we have some more questions for you from the chat that I'm going to get to real quick. I do prioritize it. So I have someone saying there's only 65 people in the chat. You can read all the chats live on air. We actually only have about 15 more minutes, and I do prioritize it to my patrons because I feel like if they're supporting the show and they're
Absolutely.
And they're supporting my show financially, then yes, I absolutely want to give you priority to come join us live on air. If people use super chats, then that is prioritized. I do try to get to as many as I can other than that, given time, but some of the questions can be long and drawn out. And so I do prioritize it that way. Real quick, I did want to kind of get a little bit of your feedback when it comes to the world of Bitcoin. You see all these get-rich-quick websites that say, oh, you can beat the system and invest in Bitcoin and make, a 2,000-fold return on your investment. And then shortly after it crashed from 18,000 to, I'm not sure what it's at now, but it dropped well below 10,000. I think it kept going down. What are your thoughts on cryptocurrency? Do you see a future in it? And do you advise anyone sticking it out for the long term, buying low and seeing where it goes?
Yeah. Amazingly, about what is today? 3 days from now is the 1 year anniversary of my super mega special double Bitcoin episode. So I think it was December 22nd. I actually ended up putting out 3 podcasts in one day because I had something else planned and the Bitcoin thing exploded. And 4 days before I put out my show, Bitcoin did actually hit intraday $20,000 a coin. And on that show, I unequivocally said, get the fuck out, get out now, sell any and all cryptocurrencies that you have. And I declared that Bitcoin specifically cannot succeed. There is, in my opinion, there is no good price that it's a bargain. I wouldn't own it. I won't own it. I recommend against it most earnestly. And just for reference, in the last few days, Bitcoin has been around $3,000. So it went from $20 to $3,000. And I always love, because you get a day like today where it went from 3,200 or 3,400 to 3,700. And they're like, Bitcoin's up 10% in one day. Yeah, suck it, baby. You're still down from $20,000. It went from 20,000 to 3,000 something. I don't see that getting better. But maybe it does. And I don't care if Bitcoin goes to 10,000 or 20,000 or 50,000. My answer is still going to be no, no, no. And maybe someday I'll eventually be proven wrong. But Bitcoin is not an investment. We can debate that all you want. I originally said it wasn't a currency. And some of my smart listeners debated me and convinced me. And I had to change my opinion because I do change my answers sometimes. It is a currency. It is a very shitty currency. Because if you own a currency that could double in value and you think it's going to double in value, you're not going to buy anything with it. I mean, if you're thinking that you're going to buy a $30,000 car and your currency is going to go up in price and double, and the car might only be $15,000 next year, you're not going to buy anything. And if the value of your currency could fall by half or 80% or 85%, the people who you could give the currency to in exchange for goods, they don't want to take the money either. So it's a shitty currency. It's too volatile. But like I said, I did a 2-hour show where I explained what mining is, what hash power is, how the code works a little bit, how it's controlled by a vote and it can be changed at any time. And about 1.5 years ago, Bitcoin Cash was created out of, dare I say it, the ether. And poof, you had another $16 million Bitcoins in a currency that was supposed to have a limited supply. It doubled in supply overnight. The whole thing is a giant clusterfuck, and I won't touch it.
It's funny you say that because I actually had a couple of my followers who asked me multiple times. They said, do you have a way to donate in cryptocurrency? Can we donate to the show? And I was like, oh, okay. I set up a Bitcoin wallet. I was like, I didn't buy any, but if people wanted to support the show, and I got, I want to say about $20 in Bitcoin that was donated to me right before it spiked, and I sold at the top. Yay. And I got $200 in donations from it. So I understand the volatility. At the same time, I ended up just at the fortunate end of that.
Because as as a method of transfer of value, it's phenomenal. Which, if you don't understand the nuance between what I just ranted about and this, like, for example, if I need to send money, like if I've moved to America and I came from Nigeria, for example, and I have a nice job and I want to send money to my family, sending international money is a huge pain, kind of what we were talking about before. But if I open up an account in Bitcoin and I buy Bitcoin and I send it back to my family and they get Bitcoin in an instant, well, sometimes within days, because that's another problem with Bitcoin, but they get the money within a couple of days. They sell the Bitcoin in the local currency. That's so magically easy.
Well,
So
and it's decentralized. It's private. It's
so magically easy. It might become illegal at some point because a lot of Bitcoin transactions, a lot of cryptocurrency transactions are done for illegal activity, which is, whether that's a good thing or a bad thing, we can argue another time. But if you want to transfer value from one place to another, cryptocurrencies, or Bitcoin in particular, are amazing. Absolutely amazing. Incredibly efficient that way.
Yeah. The other thing too is depending on where you have it stored, you could potentially lose your entire Bitcoin investment. So there have been sites that have been hacked where people lost their entire Bitcoin investment. There have been people who have stored it offsite, and they've lost entire investment. So there's ways to protect yourself from that. There are, but you have to know what you're doing. But it's definitely not the most. There's definitely volatility issues.
And like I said, I did 2 shows on that a year ago, and I just did a year in review just 3 or 4 weeks ago, and I had on a guest who is a professional writer, I think for Fortune magazine, and he's been following cryptocurrency for 10 years, and he came on the show and we talked about it. So if you want to learn more details and how it works, that might be a nice place to start. But when I started to learn about cryptocurrencies and I would go to YouTube to try to learn, holy shit, some of those people, I mean, I almost expected people to have tinfoil hats on. It was crazy as shit. It's all about the Illuminati and the Rothschilds and aliens and Stonehenge and buy cryptocurrency. It was pretty tough for me to get into and get started. And the other thing that's really funny with cryptocurrency, and this also applies to things like Bitcoin and Betterment, is everybody who's telling you that you should do it is getting paid $5, $10, $25 to tell you that you should do it. And so it almost becomes like its own pyramid scheme. It's its own Ponzi scheme. Because as long as I can hype it more to other people and make the value go up, I can make money.
But doesn't that also happen some with like the stock market and people who manipulate the stock market? I've noticed
it very easily can. And the easiest way to do that is with penny stocks. If anyone's ever seen the movie The Wolf of Wall Street, that is about penny stocks. And there is a legal limit to how much commission a broker can make. And that limit is 50%. They can't make a commission higher than 50%. So you make a $5,000 investment, their commission could be $2,500. So your investment has to double to break even. I mean, you're going against the wind, a really strong wind, but they have a huge motivation to convince you to invest $5,000 because they make $2,500. And I tell you what, when they make $2,500 from you, they don't put it in the same penny stock that they fucking talked you into. They pocket it. They don't want to invest it because that shit could go poof tomorrow.
Or they invested in index funds.
They invested in an index fund. Yeah. So
real quick, I do have Erstwhile who's here with us. But he said that he doesn't have mic or he doesn't have headphones. He doesn't want to get feedback, so he's just asking in the private group chat. But he asked about how much term life insurance should a young person have, if any, especially if they're single. And while you're answering that, it looks like I forgot to plug my charger, so I'm going to grab it real quick.
Yep. So term insurance, usually insurance is something you buy to protect someone else. So if you're single and you have no kids, you don't necessarily need term insurance at all. The one exception that can be a problem is that if you don't get term insurance and then it is discovered that you have some kind of illness, not even necessarily a terminal illness, but if you have diabetes, if you have bipolar disorder, if you have a whole laundry list of other illnesses, and then you decide you want to buy term insurance, it could be wildly more expensive or almost even impossible to get. So having some kind of term insurance as an adult, once you get out of high school or college, might not be a bad idea. And the amazing thing, if you buy term insurance when you're 20, it's comically cheap. It is awesome. Now, how much should you have if you have responsibilities? A really quick shortcut way of thinking about it is 5 to 10 times your annual income. So if you're making 50 grand a year, 250 to 500,000 might be a good idea. If you die and someone who cared about your significant other gets the $500,000, they could of course spend $500,000 in a few weeks, or they could spend $25,000 a year in perpetuity forever, about 5%. So they would have 25,000. And so if you were bringing in 50, they now have 25,000. It might be tough to pay the bills. They might have to work, but they're doing okay. If you want to make it like really, really safe, you go up to 20 times your income so that your 50,000 is replaced with $1 million, and they could pull out 50 grand a year, and at least on the scale of $50,000, never have to worry again. They could always have $50,000. So hopefully that helps some.
So I have another question about skepticism in the world of money. Oftentimes you see news articles that'll say, hey, this is exactly where you should invest. Here's this, amazing company that's doing super well. But I feel like the moment that those articles come out, you've already missed your shot. They've already inflated the stock price. Should you invest in stocks that you see news articles, splattering all over the internet?
Since I do only index funds, I'm talking about Vanguard large cap growth and small cap value, international fund, real estate fund, different types of bond index funds. There's a lot of different types of index funds. My short answer is no. I don't do that. I don't think you should do that. Now, how bad of an idea is it? It's pretty bad. And you can have situations where, like, for example, this is probably more topical for everybody. Investing in pot. I have so many people saying, hey, Phil, this is going to be a booming industry. And we have people setting up shops, and they set up a second shop, and they're working on a system. They're going to develop a chain of stores.
I've heard that investing in pot, wait for it, is lit.
And you have all these growers and all this stuff. And if it becomes legal everywhere, I could make a fortune. Well, yeah, maybe you could. But maybe if it becomes legal everywhere, Philip Morris steps in and grows more pot than you can ever imagine in Indonesia, trucks it in, or ships it in, I guess, ships it over the Pacific Ocean, and they have all the distribution chains, and every single fucking gas station in the United States of America suddenly starts carrying Marlboro branded pot cigarettes, and all the local dispensaries are run out of business. And you're fucked. All your money just went poof. So it's not something that's a growth industry doesn't mean you're going to make money. For example, when satellite radio launched, we had Sirius and XM satellite. People thought the cost of entry is high, so you're not going to have competition. This is going to be a fucking money printing machine. If you invested $10,000 in Sirius and $10,000 in XM, you would now have about $400 left. Because they both almost went, and they still might go, it's now Sirius XM, it still might go bankrupt because the cost of maintenance, hiring the people, getting the ads, it's a hard fucking business to make money in radio. And this is radio in the satellite. It's even more expensive. So it's something that looked like it was a no-brainer way to make a ton of money. And nobody made money. Everyone lost money. So just
what about investing in the growers rather than the distributors?
Well, and it's the same thing with the growers, because you're investing, I'm assuming, in some local farm, some small business. If the federal government decides, a bunch of evangelicals get in and they decide that pot's going to be illegal, and it is illegal federally, by the way, and they're going to actually enforce the law, and they raid all the farms and burn all the crops, poof, your investment went up in smoke. Right? Not in a good way. And if it does get approved everywhere, And like I said, Philip Morris decides to start selling cannabis cigarettes in every gas station, and they outsource the stuff from Indonesia and Mexico, and they bring it all in, and all these little growers, the price falls so far that they can't make a penny, and they all still go bankrupt. So, I mean, you can create these scenarios. You have no way of knowing. And so if you want to take something like that and roll the dice on it, fine. 5% of your portfolio is the limit. And have a little fun.
Yeah.
But serious long-term investing is not, in my mind, picking stocks because you think it's going to be cool and trendy and it's going to grow, because you might lose all of it.
Yeah. So basically, Chief Nerd saying pot stocks are a bubble. If you know when to sell before the bubble bursts, you'll make big time.
Yeah.
The question is how many people are not going to sell in time.
Yeah. Bitcoin got compared a lot to the tulip mania from several hundred years ago. And I said that the big difference between cryptocurrency and tulip bulbs is, at least with one, you could get a flower.
So we have also in the live conversation, we have Couture Skeptic. I did mute your mic because we were getting a little bit of feedback, but you should be able to unmute it if you have any questions to ask. I'm not sure. I know before we've had a few mic issues, but welcome to the chat. We're so glad to have you. We are about to wrap up here just in the next couple minutes. It looks like you just unmuted. Do you have any questions for Phil?
Sorry about the mic issues last time.
Give us your question.
Phil, now would be time to test them because we're about to wrap up.
Sorry, my mind's just gone completely blank. Mine was a tad more long-winded, so if you're just going to wrap up, I'll get off.
Well, if you think of the question here in the next minute or two, you're welcome to pipe in. But if not, we are getting a little bit of a buzz from your mic. So just when you think of it, you're welcome to pop back in. But I'm going to mute it right now if that's all right.
Yeah, right.
Okay.
And then I did have a question actually.
Okay, Cody.
So I'm new to investing and trading, and one of the things that I've heard, or one of the pieces of advice that I've commonly found, is find your own style of investing that works for you. And basically my question is, what are the pros and cons of trading versus investing for the long term? And by trading, I mean trading such as swing trading and day trading.
Yeah. So the more often you trade, the more expensive it is. So you can get, some places even now have free trades, or it's $5.99 or $12.99. But almost always when you get free trades, you have to get some kind of premium package where you're buying the data stream so that you can trade quickly and efficiently. So that's where they get the money from, and they want you to trade. Mm-hmm. Another thing is that if you buy something for $1,000 and you sell it a few weeks or even later in the day and it's $2,000, and you made $1,000, you're going to have to pay ordinary income tax rate on that growth. And that's going to be 24, 28, 30% plus state income tax, depending on where you live. If you hold it for more than a year and you keep holding it, you pay no tax. Now you pay tax on the dividends, but the growth that you made from 1,000 to 2,000, you pay no tax. Okay. And so that gets to compound year after year after year. And the current long-term tax rates for most people are either 0 or 15%. If you make a lot of money, it's 20%. So, so one thing is, do you want to pay 20, 30% or more tax, or do you want to pay 15? Mm-hmm. So there's that. So you've got to make so much more that you're saving. You can afford the extra tax because you made a ton of money. So it's really hard to do. The other thing is I did a show probably 6-9 months ago that showed that in any given multi-year period, like 5-10 years, half of the total stock market return was limited to 4% of the stocks. Now, it's kind of a trick because more than 4% of the stocks go up, but usually there's a handful of stocks that go up a lot. Mm-hmm. And we know what those are today. Those are Apple and Facebook and Amazon and Microsoft. They're the ones that over the last decade or more, or sometimes less, have made a lot of money. So the vast majority, more than half of all the returns historically has been shown to be from 4% of stocks. So if you're randomly buying stocks, if you randomly buy 25 stocks, odds are you got one of them right.
Okay.
And the other 24 are wrong. Now, some of those will go up, some of those will go down. And another really weird way of looking at things is that if you go long enough, every company eventually goes broke. So it's kind of, when you take something to an extreme, it becomes ridiculous. And that statement is one of those. It's ridiculous. But you have companies like IBM, that was amazing. And it was one of the biggest companies in America. You had Enron, you had, what was the one that was in technology? You had Polaroid was the number one camera and film maker and developer. And they had the magical cameras that you take a picture and you get it right there on the spot. Fucking went bankrupt. Fujifilm, same thing, went bankrupt because the world changed around them. Kodak, one of the things I would jokingly tell people with cryptocurrency, Kodak came out with a Kodak coin. And if you ever had any doubt that cryptocurrency was doomed, when Kodak comes out with a coin, it's over. Because these are the people that owned the camera market, they owned the film market, and they thought digital cameras will never take over. So some of the companies that were the biggest back 10, 20, 30 years ago in the United States are now worthless.
Yeah.
Kodak actually came out with one of the world's first digital cameras and basically said, this is useless. We want people to continue buying film.
Well, of course, it's in their self-interest to not change the paradigm. And sometimes that's the right thing to do. Sometimes it's the wildly wrong thing to do. So with this idea that 4% make all the money, odds are that you're not going to buy the right ones, or you're only going to have a couple of right ones. And in the other stocks, you're going to have some losers. When I was growing up in junior high and high school, I knew that my dad was a stock picking genius because we would hear about the stocks that he bought that doubled and tripled and went up 10 times. And when I came home for my first summer of college, he said, I'm going to show you what I do in case I get hit by the proverbial truck, you can take care of the family. Well, then he showed me about this company that he bought that was going to make a 3-wheeled car. And it was going to revolutionize the world. Yeah. Three-wheeled cars aren't very stable. It's just a really big problem with the design. And that stock went bankrupt. And he had another stock that he was still holding. And I said, what happened to this? And he goes, it went down a lot. And I go, why don't you sell it? And he goes, it would cost more to sell it now than it's worth. You have cases like, a funny thing, a Kmart, I just recently talked about this. The Kmart company went bankrupt and everyone that owned stock got zero. But then they restructured and issued new stock and had so much money to play with, they fucking bought Sears. Most people think Sears bought Kmart. They did not. Kmart bought Sears with money they had from reissuing new shares. And now collectively, Sears Kmart is going down the toilet. And I take the position that the vast majority of that was engineered by a brilliant investor who sucked all the money out like a vampire sucking blood out of a body. And he's made billions of dollars and everyone else gets fucked. But that's a whole nother subject. But picking individual stocks, it can be done. But the data shows the vast majority of people underperform the stock market. The average person underperforms the stock market by 4% per year.
Wow. So on that note, I do have someone. We're about to wrap up. Any last minute super chats you guys want? If you want a last minute answer from Phil, make sure to send them in right now. I do have a quick comment from Funny Sturstay. Says, I want to be honest, I have no idea what he's talking about. And I think that this kind of undermines a really important point when it comes to the world of investment. This stuff is complicated. Yeah. It's not easy to wrap your head around. It takes a lot of studying and reading and just exploring these topics, getting kind of an entry level understanding. A lot of this is over my head, and I've been reading a fair amount about investment, even though I haven't really done a whole lot myself. But that's why you hire an expert. You hire someone like Phil to manage your funds. If you're just now joining us or you missed the beginning of the show, I really encourage you to go back and listen to that, because we do talk about how to find a financial advisor who will not dupe you and not rob you of your money. Some of the advice was, making sure that it is a fee-only advisor that has a fiduciary responsibility to you, and that is, they're being paid by you, so they will work for you, as opposed to getting commission by selling you on all these programs that you don't need.
Absolutely. And the other thing, of course, they can listen to the Phil Ferguson Show. Comes out
Absolutely
every 7 to 10 days. I get kind of busy sometimes. Absolutely free. Of course, I now have a Patreon page as of today. Yay. But you can listen to that. I've been doing that been doing podcasting for like 5 or 6 years. And the show is part finance, part politics, part atheism. So it's all the 3 things you should never talk about with your family. But I teach people how to money, and it's absolutely free. You listen to it, you learn things. You can send me emails. If someone has a specific question, my email is phil@polarisfinancialplanning.com. You can send me an email there. I'll try to get an answer to you. If I don't respond, I'm not trying to be a douche. I get a lot of emails. Remind me if I don't respond. But yeah, get the education, because a year or 2 of learning about how it works, you're going to be doing this for 30 to 50 years if you're lucky, or more.
Yeah.
So take the time. And I gave the book list early in the show. Go back if you missed it.
And as a fan of your show myself, I have to say that it is evergreen content. So you can go back to the original episode and listen to episode 1 of the Phil Ferguson Show, and this is stuff that, related to the world of investment, that it's not changing. It's not like all of a sudden interest rates are just, that the way that interest works is just going to suddenly disappear. The math is just going to go away. Like, stuff is show for sure. Phil, why don't you, while you're at it, why don't you plug your Twitter and your Facebook handles, or anywhere else that people can find your work?
The Twitter is @SkepticMoney. The Facebook page, of course, for the podcast is The Phil Ferguson Show, because I'm really fucking clever. And I agree, beta is the way to go for videotapes. if we're to use videotapes ever again. But yes, that's how you can find me. Of course, I just gave out the email address. If you send me an email, just make a note that you're a friend of Thomas's, you listen to a show. And of course, if you're a patron of his, make sure you put that in there, because I want to give a little love back. But I appreciate you having me on, Thomas.
Yeah, me too. Real quick, somebody asked me how well my fund returns on average over the past year. And I do not have any investments at the moment, because I am paying off debt.
So I fucking foam behind you, dude.
This is actually 100%
donated,
donated by my patrons, by viewers like you.
The rate of return, it's one of those things that sometimes I do talks in person to skeptic groups or to local like Rotary clubs, things like that. And the one question that's the hardest question for me to handle is, what is the average return for my clients? And I tell people I can give them a really short answer, a short answer, or a long answer. And they say, well, give me the really short answer. And I'll tell them that the data is not available. And they go, okay, I need a little bit longer answer. I go, okay, the data is kind of available, but I'd have to take every single client. And some people are in retirement. Some people are 20. Some people want to take a lot of risk. Some people don't want to take a lot of risk. I could mush it all together and give you a meaningless number, but that still sucks. And then they go, well, I want to get a little longer answer. And I go, and it doesn't even matter, because that's all historical. And what happened in the last 5 years is irrelevant to what's going to happen in the next 5 years. But if you look at the stock market in the long run, 5, 10, 20, 100 years, it makes 10% a year. This year, it's kind of break even, maybe down a few points. The year before, it made 22%. There's no way to know.
Yeah. Wonderful. Well, thank you so much, Phil Ferguson, for joining us here at Holy Kool-Aid. If you would like to support Phil Ferguson, go and check out his Patreon. I will throw a link to that in the video description. Also, go follow him on Twitter. Go listen to his show and subscribe to it. It is fantastic. The Phil Ferguson Show. I highly, highly, highly recommend it. And if you end up at a conference, going to a skeptic or atheist conference or something, there is a chance that you will run into the Phil Ferguson. I keep crossing paths with you at various conferences. So hopefully I can meet up with some of you who are watching right now at future conferences, and hopefully you'll be able to meet Phil as well. Phil, any final words before I end the show, or any final words from any of my patrons?
Patrons, what do you got?
Thank you for letting me join this discussion.
Thank you.
Thank you for
Awesome.
your words of wisdom.
I hope I didn't swear too much for anybody. Have a good night, everybody.
Cool. Well, thank you again for coming on. And to everyone who's watching, remember, dare to be curious, but don't drink the Kool-Aid.